I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for joining me.
Well, thank you, Charlotte. Good to see you again.
Good to be catching up with you as well. And it hasn't been too long this time.
It has not.
We saw each other at the end of January or so in Vancouver at BRIC, and we had a shorter conversation on gold at that time, and I thought I would follow up on a few of the points. So you had told us, or you emphasized, monetary factors are what's most important for gold right now. So I thought we could start by checking in on the Fed. We got PCE data this past week, and we know that's the Fed's preferred measure for inflation. So I thought we could start there and get your take on that and what the Fed may be thinking as it looks at that.
Yeah, well, again, I mean, if we stand back, we know that the numbers that are put out grossly underestimate the rate at which prices are going up. And the other thing that's important, and Jerome Powell, the Fed chair, to give him credit, has said this himself, but even if prices are only going up 3% this year, that's 3% on top of what they went up the year before, on top of what they went up the year before that. So for most people, the increase in prices is greater than their income is. Most people are not keeping up with the increase in prices. I think if you look at those numbers, clearly we saw that services were moving up significantly. But the only reason goods were not moving up so much, of course, was because the demand for goods is going down. I suspect that we're going to see the core CPI, for people who don't sleep and don't, homeless people who don't eat. The core CPI is still 40% above the Fed's own target. So they have not yet achieved. What they themselves are trying to do, which I think is important to realize. But I think what the market is beginning to sense. I mean, we've talked before about how the most favorable environment for gold is stagflation, a period when inflation is stagnant or moving up, or when the economy is stagnant or moving down, a stagflationary period. And what we've seen in the last increasingly in the last 6 or 8 weeks in the U.S. are signs that we are moving into that environment. And, at this point, people who believe in the soft landing and people who believe in the tooth fairy, they simply cannot ignore that the economy is slowing. I mean, everything you look at, whether it's new jobs claims, continuing unemployment claims, new home sales, manufacturing, the list goes on and on and on. Pretty much every indicator you look at is trending downwards. I don't think people can ignore anymore that we're heading towards a recession, and it's not going to be too far away.
I think, you say, okay, we can't ignore this. And I think that maybe what's allowing some people to do that is watching how the markets are looking with the tech stocks. I think we maybe talked last time about the Magnificent Seven and everything going on there. Any thoughts on that? Because I think that may be confusing.
No, you're absolutely right. People conflate the market with the economy. I mean, it used to be the stocks followed the economy. When the economy was doing well, earnings, people spent more, earnings went up, so companies did well. Now it seems to be almost the other way around, that the economy is meant to follow the market. I think people put too much weight on what the stock market's doing. If you've remember, we've come off a period when we had ultra low interest rates. That enabled companies to term out their debt, to borrow more at low rates, to term it out. So you have extended maturities, and companies in pretty good shape, so they can withstand a slowing demand for quite a period of time.
I think at the same time last time that we spoke, I had asked, are you expecting a stock market crash? And you had said no, but a rotation toward value away from growth. And I was going to ask, are we starting to see that?
I think we're starting to see that. If you look at the Magnificent Seven, obviously NVIDIA shot up on their earnings, but we've seen some stumbles in some of the others. So yeah, I think we're beginning to see that a little bit. I mean, the plain fact is that I think people who are willing to invest in Tesla and NVIDIA and Apple at these prices, we're sort of exhausting them. People who believe in those companies are all in. And I don't think there's a lot more buying power for those companies. But the other thing, I think we talked about this last time, but on the other hand, we must not forget that the Magnificent Seven, they represent nearly 20% of the entire market, of the entire world's market capitalization. So if you're an investor in Switzerland or Hong Kong or London, you can't ignore those 7 people. If you get new cash, new inflows, some of that money will go into those stocks.
Okay, so we know monetary factors most important for gold, but I thought we should follow up and talk a little bit more about some of the secondary factors that you are watching this year for gold.
Okay, is there a question? No, I'm sorry. I think it's important. Geopolitical factors tend to only have a short-lived impact on the price of gold. And right now, of course, we've got a pretty scary situation with a war in Europe, the most dangerous war in the Middle East for probably 40 years. And we've got what's happening in the Gulf, which is associated with the Red Sea, which is associated with the Middle East. So there's a risk of the Mideast conflict expanding. And yet, I think that's a very short-lived impact on the price of gold. Historically, it's always only lasted a couple of months at the most.
And we're in an election year, and I want to bring it up. I have a feeling you're going to tell us that it probably isn't very meaningful for gold, but I'm going to mention it anyway and just see what you have to say if that's something we should have to consider.
Yeah, no, definitely. I think it is. I mean, I think the monetary factors are the underlying factors, but there's a lot of other things that can affect gold. Now, I've got to be careful how I say this. Don't want to get a lot of. But if you look at the U.S. today, and you've got Biden and Trump. It's not so much Biden and Trump. You look at the supporters. A recent survey. This was actually at the end of the year. In answer to the question, do you believe it would be right to use violence to stop the other people taking control of government if they win the election? 42% of Democrat voters said it would be right to use violence to stop Donald Trump taking office, even if he wins. Now, that's pretty astonishing. Now, I suppose if you genuinely think that Trump is the second incarnation of Hitler, then using violence is appropriate. But almost half, and for Republicans, it was about 37%. So, well over a third of the population thinks that it's appropriate to use violence to stop the other side taking office. So, even if you have the cleanest possible election out there, which we're not going to have, people still think it would be right to use violence. Now, if you have elections where people think ballots were stolen, or the Russians influence social media, or whatever it is, that only exaggerates your feeling. That only heightens your feeling. But it's right. So I'm afraid that we're going. I'm not the only one saying this, of course, but I'm afraid we're going to see some pretty nasty violence, in the streets, as we get closer to the election.
Well, we'll have to keep an eye on that. I hadn't heard that statistic that you mentioned.
No,
that's quite alarming.
It's shocking. It's alarming. And that is, again, it's a geopolitical event that is a positive for gold. It's not the overwhelmingly positive factor, but it's a positive, not a negative.
And I'm just going through my list of possible gold factors for 2024. Central banks, very strong buying the last years.
Yeah.
2024, are you expecting similar?
I think we're going to see continued central bank buying. Well, obviously that'll ebb and flow a little bit, and obviously they can't go over 100% of their reserves in gold. But no, we've seen a fundamental, that's a long-term fundamental switch because of the weaponization of the U.S. dollar. Central banks are buying gold as a defensive measure against that. And the U.S. can't say, you know what, I know we've sort of tried to tell you guys what to do for the last few years, but we're not going to do it anymore, so everything's okay now. I mean, no one's going to believe it. Whoever says it. That's not a political point. I mean, the U.S. for 40 years, really, has been telling other countries how to run their business. We saw the attack on Swiss banking privacy. We saw the multi-billion-dollar fines on Bank Paribas when they financed a Spanish company building a hotel in Cuba, which under French law and under Spanish law was legal, but the U.S. says under U.S. law it's not legal. And so they fined Bank Paribas. I mean, this is astonishing. When you think about it, that's astonishing arrogance and interference in other people's, right to do business the way they see fit. And then, of course, more recently, I've seen the confiscation of Russian assets. Now, whatever you think about Russia and Ukraine, there should be, in my view, a judicial process. The government shouldn't just be able to confiscate the assets of Russian oligarchs, which is a very, very broad term. Remember, they weren't confiscating the yachts and the Chelsea apartments of Putin and Putin's generals. They were confiscating the assets of wealthy Russians without due process.
I think that puts the central bank buying into context. One thing that I'm wondering is, at what point or at any point will we see Western central banks maybe start to add to their gold reserves?
Well, Western central banks, of course, already have a very high allocation to gold, whereas U.S., Germany, France, Italy, they all have a very high allocation to gold. Canada doesn't, of course. Britain doesn't, of course. Britain famously sold the last of its gold right at the absolute bottom in 2000. Ouch. I don't think we're going to see... I'm not expecting a resurgence of Western central bank buying gold. No. But I am expecting a resurgence of institutions and retail buying of gold, which has been absent. We've talked about that. I mean, the latest numbers I've seen on global gold ETFs, right? All of them added up together. This year, you're still seeing every single week, you've had net outflows. We've had 44 tons outflow from gold ETFs this year, which is significantly more than the outflow for all of last year. So Western investors, far from actually buying gold, are still selling it. And that's going to change pretty soon, I think.
And what do you think will be
the catalyst? Simple. It'll be a higher gold price because Western investors typically, painting with a very broad brush, people chase price. They do not buy when things are cheap, but they chase price. So you see gold over 2,100, which is coming very soon, we hope. We only need one more day like Friday. But you see gold go over 2,100, that starts getting people's attention. Goes to 2,150 and doesn't drop below 21. I think increasingly more people will start buying. But it's a higher price that will get people to buy it.
So 2,100, 2,150, I feel like I used to hear 2,000 was the number and that would do it.
Yeah.
So it feels like we've moved the goalposts or somebody has moved them a little bit.
Well, we went backwards and forwards on 2,000 so many times, bumping up against it, falling back. Yeah, I mean, I think it's a continuum. It's not something that well, one day nobody's buying and the next day, okay, we're there. It's a continuum. So frankly, staying above 2,000 is very, very significant, very important.
Okay, so I thought we could take a brief look at the gold stocks as well, just as we're getting toward the end. And I know that you've told us before they're very undervalued right now. Now is the time to get in. I was thinking, often you talk about royalty and streaming stocks as a way to get lower risk exposure. And we can talk about your thoughts on gold stocks right now, but I have a specific question on Franco-Nevada because they have the Cobre Panama royalty going on. And I thought you could weigh in on that because this is, it's a low risk, but things like this can happen. So I thought you might have some.
Yeah, well, no, absolutely. I mean, the thing about the royalty model, the royalty companies, is that it's low risk. They're not exposed to the same risks as the mining companies, but it's certainly not no risk. And we saw that clearly with Cobre Panama. You look at Franco-Nevada, for example, and some of the other royalty companies, Wheaton, you could say the same in Royal. But you look at Franco-Nevada, Cobre Panama was about 16% of our NAV. When Cobre Panama was shut down, Franco-Nevada lost about 26% of its market cap within a month. At the same time, the Wheaton, its closest peer, went up 12%. So that's a spread of over 36%, but Franco-Nevada lost compared with Wheaton. When the mine is only worth 16% of our NAV, even if the mine is zero, which I don't think it will be, because at worst they'll gain something back in arbitration, right? That's at worst. That's even if the mine doesn't restart. Now remember, if after the election in Panama in May or whenever it is, the government decides to renegotiate with First Quantum, I'm not saying you will, I'm just saying if they start to renegotiate and First Quantum has to make a lot of concessions, but the mine restarts, well, those concessions all are on First Quantum. They don't affect the stream that Franco has. That's the beauty of the streaming model. When you look at Franco-Nevada, as I say, 16% of their NAV, that's their largest single asset. After that, they've got three assets that are 10%, 10 to 12%. And then after that, they've got over 100 different revenue-producing assets. So very, very well diversified. They've also got a pipeline. They've got about over 300 royalties or streams on assets, not in production. Some are close to, some are in development. Three new ones coming on this year, three big ones coming on this year, which I think will move the stock price a little bit. But three big mines coming on this year, including Cote and I'm sorry, it slipped my mind for a second. And some of those 300 mines will probably never come into production. But nonetheless, it's very well diversified. And most important of all, they've got $1.2 billion in cash. So they're not going anywhere. You don't have to worry, is Franco going to go out of business? That's just not even a concern. Whereas potentially it's a concern with First Quantum. I'm not saying it's going to happen, but First Quantum doesn't have $1.2 billion in cash. They have a lot of debt. So, and now they're having to sell some of their assets, sell interest in some of their assets just in order to reduce the debt or service the debt. So that's a huge difference between the operating mine, the operating company, and the royalty company.
Yeah, I think that was very well explained, and I just brought it up so that we could kind of see a case study of how that works, the royalty,
right.
The model. So I think that was good to go over for investors.
Sure.
I think as we're finishing up, I know last time you told us this is a real opportunity in gold stocks, and you don't. I've said it before, but it's still true. I don't want to make you repeat yourself too much, but are there any thoughts that you would add on either gold or the gold stocks as we move forward?
Yeah, I think the thing that I would add is that I think this is going to change very, 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 very soon, but more importantly, it's going to change very, very dramatically. But at the moment, it seems as though investors are looking for the bad news. When a company when a company comes out with when a company like Pan American or Fortuna or Barrick or Newmont or whatever, a company with a lot of mines in different places, when they come out with their annual results, there's always going to be something that went wrong. Always. Murphy's Law, anything that can go wrong will go wrong. And Robert Friedman famously said, Murphy works overtime in the gold mining business. So things are always going wrong. That's just a fact of life in the mining business. And I get the sense that the investing community is searching out the thing in a company's quarterly results or annual results that is wrong. So Barrick, for example, they pre-announced their production. They had a miss on their production, frankly, from very, very aggressive production numbers. But most analysts were saying repeatedly for 3 months they're never going to make. Lo and behold, they didn't make them, and the stock dropped 14%. But everybody who follows the company knew they weren't going to make their earnings. Then they came out with their full financials, and they showed free cash flow up 50% for the year. That's nothing to sneeze at, and the market kind of just ignored it. So I think the market, and we could go through Pan American, Royal Gold. I mean, Royal Gold had a good fourth quarter, very good fourth quarter, but they missed their annual guidance. Royal is one of those companies that doesn't continually update their guidance. Now, they missed their guidance because Penasquito, one of their large streams, had, a 6-7 week stoppage because of a strike. Everybody who follows Royal Gold should know that Penasquito was down for 7 weeks. I mean, it's all they talked about on their third quarter earnings. So what makes people think that their annual guidance is going to be met? The annual production guidance is going to be met. Of course it's not. One of their large royalties was down. One of their large royalties, was down for 6 or 7 weeks. But the stock went down when they came out and said we missed our fourth quarter, even though they had a great missed our annual guidance, even though they had a good fourth quarter and they had good 2024 guidance. So I think that's a sign, that to me is a sign of almost capitulation among, remember, anyone who still owns a gold stock, is a hardy person. And so we're now seeing capitulation among the last remaining survivors in the sector. That's a signal that we're very, very close to an end, in my view.
Okay. I think that's a nice place to wrap it up for today. But we'll check back in with you later and see how it's going. Thank you so much for coming today.
Well, thank you very much, Charlotte, for having me. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Adrian Day of Adrian Day Asset Management.